Okay, welcome back to Accounting 401, Taxation of Individuals, Chapter 4. We're going to have, let's see, what's it entitled? An Individual Income Tax Overview and Dependents, and Filing Status. Okay, three learning objectives in this chapter. Describe the formula for calculating an individual taxpayer's taxes due or refund. Explain the requirements for determining who qualifies as a taxpayer's dependent and determining a taxpayer's filing status. All right. Well, in a nutshell, describe the formula. There's two ways you can compute the tax. Again, we have to work down the forms, getting from total income down to adjusted gross income, then finally taxable income. And then once you just determine the taxable income, you can either go to the tax tables, which is a book published by the IRS that is just page after page after page after page of columns of numbers, with the left hand going down being $50 increments of income, taxable income, and going across the top are filing statuses. And you just go to where the rows and columns intersect, and that is the tax for that level of taxable income and a given filing status. In learning objective 2, in a nutshell, explain the requirements for determining who qualifies as a taxpayer's dependent. That's relatively straightforward. Anymore, it doesn't affect, it used to affect taxable income. It doesn't anymore since the Tax Cut and Jobs Acts of 2017. But we still need to figure dependency because a lot of the tax credits, you need a dependent for them. Earned income credit, education credits, certain other ones. Can't think of off the top of my head. And finally, determining a taxpayer's filing status. There are 5 filing statuses: single, married filing joint, married filing single, head of household, and qualifying a widower, surviving spouse, qualifying widower. All right, let's jump into the chapter here and go through it page by page. So again, I like this textbook because the storylines they give you bring the theoretical material into a practical viewpoint, and the examples are pretty good. So let's turn the page there. Now let's see. These ebooks are getting to me. All right. It doesn't turn, and then all of a sudden you hit it, and then it turns 5 pages on you. Exhibit 4.1 is a basic overlay or formula. You can see up the top they have gross income, and then you have deductions for AGI. AGI is the acronym for adjusted gross income, and those are referred to as above the line deductions. And then that gets you AGI, adjusted gross income. Then from adjusted gross income, you subtract out the greater amount of the itemized deductions or the standard deductions. Okay. And also the deductions for the qualified business income and the charitable contributions deducted for taxpayers who do not itemize. The Tax Cut and Job Act of 2017 raised the standard deduction way up. It almost doubled it. And so very few people itemize anymore. And why? Because you take the higher of those two, either the standard deduction or the itemized deduction, is you take the higher deduction because it'll lower your taxable income. Common sense there and mathematics. I don't know what it is this year. Back in this textbook, we'll see what the number is. Yeah, I think it's somewhere in the $24,000 range, something like that. So you have to have a lot of itemized deductions to get a higher number than that. So you subtract those 3 items out: the standard deduction or itemized deduction, whichever is greater, the QBI, qualified business income, and also the charitable contributions for people that don't itemize, and that gets you taxable income. Once you get taxable income, then you can either, like I said, go to the tax tables. They're published by the IRS, but they're limited. They only go up to, I don't know, $300,000-$400,000 if they go that high. The appendix in the back of the book has the tax. What are they? Tax tables? No, those are what the IRS publishes. The tax. I forget what they're called in the back of the book, but they have a formula there where it will show you based on. There's 3 or 4 tables for the 5 filing statuses. Head of household and surviving spouse use the same one. And you just get the level of income, and it will be bracketed into the different tax brackets, how much it is, plus the tax rate in that bracket, the marginal rate in that bracket for an amount over so much. And it's really easy to do. And in fact, you don't even need to do it, because if you're using the computer, the tables and the formulas are built in. So then you have the tax liability, the tax that is due on that income for a person with that filing status. Then you have to look at any other taxes they may have, like the Social Security tax. Okay, that's a total tax. And then you compare that with what they have had withheld, what they paid in estimated payments, and any credits. And then you figure out if there's any additional tax that has to be paid with the return, or if there's a refund if they have overpayment of their tax liability. And then you have a couple options there. You can either have it refunded to the taxpayer can have it refunded to them, deposited directly into their designated checking bank account, or they can have it credited towards the subsequent tax year and offsetting some liability for that, minimizing the amount they'd have to pay as estimated payments. Okay. They show you in Exhibit 4-2 a insert from the Form 1040, which is the individual's reporting form. The top part of it will have the demographic information, name, address, social security numbers, and if you're married, the spouses. And then you have dependents underneath there. And again, that's only for certain credits. And then lines 1 through 14 are all income amounts. Okay, wages and salaries. Take some time to look at it. Taxes exempt interest, qualified dividends, IRA distribution, pension and annuities, social securities. Notice that lines 2 through 6 have a column and then a B column, taxable amount. Only some of those things are not fully taxable. Okay. Social Security benefits at one time were not taxable at all. A while back, they started making them taxable, but only a portion. You can make up to $34,000 and not be subject to any tax on your Social Security. Above that amount, they start taxing upwards of 85% of it, up to 85% of it as ordinary income. Then you have capital gains and a few other items down there, and adjusting items, standard deduction or itemized deductions, and get you down to your taxable income. And then you turn over page 2 is the backside of the 1040. And there's the tax on that level of taxable income for a person with that filing status. And then you work down, for estimated payments, withholding amounts, and then figure out what the total payments are versus the total tax liability. Plus, the credits are considered payments to offset your tax liability. And then you see lines 34 is your amount of overpayment, the amount you want refunded to you, and the numbers there to put it in different bank accounts. They give you the option of 2. And then line 36, the amount you want applied to your following year's estimated payments. And if you owe tax, then you got to look at line 3738 and pay that amount with the return. And then on the bottom, very important, to sign the return. And it has to be signed by the taxpayer. And if you have a paid preparer prepare it for you, they have to sign it also. Schedule 1 is a relatively new form. I'd like to bring your attention to the upper right-hand corner under the date. And in this version of the textbook, the 2022 one, we're looking at a 2020 form. So the year is always in the upper right-hand corner of the form, but right under there, there's an attachment sequence number, this 01. And every form that has to be filed with that return will have a sequence number, and the IRS would really appreciate it if you put them in those orders. Now, the computer will print them out in order if you use software, so no big thing there. And this is additional income and adjustments to income. It's a supporting document in support of the amounts that are on line on the 1040. And there's references to them line by line to get through. And it tells you, look at line 9 on that form 1 after you go through all those other lines 1 through 8. Combine lines 1 through 8, enter here, and on form 1040, 1040 RS, or 1040NR, line 8. So it tells you where it goes to. So this is just a supplemental schedule that details what's on line 8 of the page 1 of the 1040. Part 2, adjustments to income. Again, they have a lot of items there, and they will tell you what lines. Everything is cross-referenced. You just have to slow down and read it and read the fine print. And it's pretty straightforward the way they have it built logically. People just don't like to do it because they're afraid of the numbers and getting something wrong. The next topic in the chapter, they talk about gross income. The U.S. Tax system is based on what we call the all-inclusive. Everything is taxable, is considered gross income, and it is taxable unless otherwise designated by the IRS code. Okay. Gross income generally includes all realized income from whatever source derived. Okay. Even if you're bartering, you have to include the fair market value. If you have a gain, if you barter your services in exchange for something else, for some other services. There are exclusions. Interest on municipal bonds are excluded. Okay. Certain other things are excluded. Okay. Some things are deferred until future years. Okay. And when you have a piece of property and it goes up in value, you don't pay tax until you sell it. And the Congress is, believe it or not, and the code are fairly logical on this, where the theory is they're not going to tax you until you have the wherewithal to pay the tax from a transaction. Although it's getting scary. Senator Elizabeth Warren from Massachusetts and some others have been talking about instituting a wealth tax where you will be taxed if your investments go up in value during the year, even though you don't sell them. Okay. Notice on the top of that page, they said realized income. Realizes if you buy some stock and you hold it, it goes up in value. You're wealthier, but you haven't realized the gain until you sell it at more than you paid for it. That's when it becomes taxable. And there's special rules. We'll talk about that. Long-term gains, short-term capital gains, and they get taxed at different rates. So again, the tax code is written with the intent not to punish people, but if you do have income, they want their fair share of it. Okay, so there's a listing of some common income items in Exhibit 4.3. Compensation for services, that would be your W-2 earnings. Business income would be from your Schedule C. Gains from selling property would be on your Schedule D or some other schedules possibly. Interest and dividends used to be reported on Schedule A if they were over $400 or $600. I don't know if that's still true. Rents and royalties are on Schedule E. I used to have a rental property, and I'd have to complete a Schedule E. I also prepared taxes for people, so I had a Schedule C. I had some years where, my return was 20 or 30 pages long with all the schedules and the supporting schedules. Alimony received for a pre-2019 decree, and annuities, retirement income, and income from discharge of indebtedness, forgiveness of a debt. Okay, you owe somebody money, they say forget about it, then you're going to get taxed as income. Underneath that, Exhibit 4.4 is a partial listing of some common exclusions and deferrals. Income from municipal bonds is excluded. Gifts and inheritance are excluded. That means they'll never be taxed. Alimony received after a 2018 decree, not taxable. Okay. Gain on the sale of personal residence excluded up into a certain dollar amount. And we'll get into that if we get to Chapter 14, I believe that is. Life insurance proceeds excludable. Installment sales are deferred, and like-kind exchanges are deferred until that asset that you get in the like-kind exchange is finally disposed of. Okay. Characteristics of income. Ordinary income, capital income. Ordinary income, they say there, is income or loss that is taxed at ordinary rates provided by in the tax rate schedules. That's, I guess, what I was referring to in Appendix C. Capital income. These are gains or losses on the disposal of capital assets. In general, capital assets are all assets other than accounts receivable, inventory, and other assets sold for sale in the ordinary course of business, assets used in a trade or business. Okay, those are reported on Form 4797 and are treated as ordinary income for the recapture of depreciation taken in previous years, and the amount above the original basis or any appreciation would be a capital gain. And then we have to determine whether it's a short-term or long-term capital gain, because there's different rates that come into play. Capital losses. You are allowed to take up to a $3,000 capital loss against ordinary income in any given year. And if you had $10,000 in capital loss and no capital gains, first you offset it against capital gains, net short-term, net long-term, and then net short, net long. And again, that's coming up later chapters. And again, capital gains are taxed at a preferential rate, not at a rate different from your ordinary income, okay, depending on your taxable income bracket. So if you had a $10,000 capital loss, you can take $3,000 and didn't have any capital gains to offset it against. You can take $3,000 off your W-2, offsetting your W-2 or your Schedule C earnings. This year, $3,000 next year. Now you're at $6,000, $3,000 the year thereafter, and then $1,000 the year after that to get rid of the whole $10,000 loss. The thing is, you can't take it all at once. You're limited. You can take a whole capital loss if you have capital gains equal to or greater than. They can be offset in any given year. If you don't have any capital gains to offset the capital loss, to use with an offsetting capital loss, then you're allowed to take that $3,000 against ordinary income and carry it forward infinitely. Okay, there's no limit on how far you can carry it forward. All right. Again, you got to be careful on some of these things. It's not that hard because the long-term capital gains are taxed at a different rate than your ordinary income. Okay, give me an example in 4.1 that'll walk you through that and probably do a lot better job than I was trying to do off the top of my head. Deductions. Deductions reduce the taxpayer's taxable income. Okay. However, they're not easily to come by because, in contrast to the all-inclusive treatment of incomes, The tax code is very specific on what is allowable as a deduction. Okay. Itemized deductions are reported on Schedule A. Yeah. And I don't know if they have one here. I hope they do. Yeah, they're getting to it a little bit further down. The AGI deductions are commonly referred to deductions below the line, AGI being the line on the tax form on the page 1 of the 1040. AGI deductions include itemized deductions, the standardized deductions, and the qualified business income deduction. Okay, so there's 3 types we have to look out for. Standard is just an average that the IRS computes based on tax returns filed in the previous year or two, and you get them. Some people get more than they're entitled to, some people less. And again, usually if you're getting less, you might have more in itemized. Also in 2017, they put the first $1 million of your mortgage. You used to be able to deduct all of it. Real estate taxes are now capped at $10,000. You used to be able to deduct all of them. That change got a lot of people in New York, New England, Connecticut, Massachusetts, California, where they have very high real estate taxes, and got those people very, very upset because there's people there with $20,000, $25,000 real estate taxes on their homes. They can only deduct $10,000 now. So, and again, mortgage interest is deductible. Again, there's a limit on the first $1 million of principal of the mortgage. I used to have quite a bit. My mortgages, I got 2 more payments on it, so I got my statement, and I was surprised I only had less than $1,000 in mortgage interest. Years ago, I used to have like 15,000. And okay, let's see. Standard deduction amounts. Here they are in Exhibit 4.7. There's a married filing joint for 2021 is the latest they have in this book. They index. Don't focus on these numbers. Don't memorize these numbers because they change every year. They're indexed for inflation and they're usually rounded. You can see from 2020 and 2021 they have listed there. It went up from $24,800 to $25,100. So it went up $300 for a married filing joint. Qualifying widow or widower went same. Married filing separate, you can see is half the married filing joint amount. 24.8 in 2021 is now 12,400, and it goes up 150 because the married filing joint went up 300. Head of household 18,650 now is 18,800, and single person went from 12,400 to 12,550. So everybody got a $150 increase in the standard deduction. And married filing joint, you have 2 people getting it, husband and, well, I shouldn't say husband and wife now, I should say spouse and spouse, and $150 each, that's $300, okay? And that's going to change. And then in the smaller italicized thing under there, people that are blind or over 65 get a little bit of an extra amount tacked on there, okay? An additional standard deduction of $1,350 for age and $1,350 for blindness. And that has to be legally blind, not totally blind. Okay. So, and again, that would be for each spouse if they're filing married joint. Again, read through that example there. It makes it a little bit clearer. These examples are a lot better than the examples you'll find in the IRS publications, in my opinion. The IRS publications, for one. They're going to give you the IRS interpretation, which they want everybody to follow. And sometimes that, they're going to look at it in their viewpoint, from their viewpoint, not necessarily the taxpayer's viewpoint. If you have a position that is that you have a sound, logical, legal argument to stand on. Okay, the calculation. You can use the tax table, which are, like I referred to earlier, are published by the IRS, but they're limited at how high they go. So if you go over a certain limit, you have to, let's see, filing status on taxable income. Yeah, $100,000 must use the tax table. Over taxable income over 100,000, you have to use the tax rate schedule. Those are in Appendix C in the back of the book. You can take a look at those. And the important thing is there, you first have to get the right tax rate schedule, because there's one for married filing, there's one for single taxpayers, one for married filing joint, one for head of household, and one for what's the other? The ones we just saw with the standard amount. Qualifying widow or widower, married filing separately, head of household, and single married filing joint. So you get the right schedule, and then you just find out what the taxable income is. Find it, and they have it. It's from, say it's like from $19,500 to $46,000, and you slide over, and I'll tell you what the tax is, and I'll say it's $2,850 plus 14% of the amount over, $19,500, whatever. It's very easy to do. Take a look at them, you'll see them. I might print it out and just show you the next next video. Other taxes. The Congress passed the alternative minimum tax, known by the acronym AMT, and the self-employment tax. Self-employment tax is your Social Security tax. Alternative minimum tax was an attempt by Congress to make the people on the upper end of the taxable income spectrum that took advantage of certain things in the tax code, and that paid little or no tax, to make them pay a minimum amount of tax. Okay, sort of a fairness. So there are people saying they're not paying their fair share. I'll have to get some data for you about who pays what. Actually, the upper 5% pay almost 40 or 50% of the taxes collected, the IRS collects. So when they say the fair share, tax the rich, and they're always complaining, the politicians, the public, and the newspapers, the news media, tax the rich, tax the rich, tax the rich. Well, the rich are who's paying, 5 or 10% of the population is paying about half the taxes collected. And since 47 or so percent of taxpayers don't pay any federal income tax, they'll pay Social Security tax but no federal income tax. How can you cut taxes for people that don't pay any tax? So, when there is a tax cut, it's going to only be for the people that pay tax. Half the people don't pay any. So how can you cut their tax? Actually, they do get a refund sometimes if they qualify for the earned income credit, and that's one of the few things that gets me very, very, very upset. I can say, let them take back everything they paid in, everything they had withheld, they could get back, but don't give them any more. Well, this credit, it's a refundable, what they call a refundable credit, and they can get more than they had withheld, and that's my money and your money going to them. That's a wealth distribution scheme. All right. Taxpayers with relatively high AGI are subject to a 3.8% net investment income tax on unearned, that is, investment income, and a 0.9% additional Medicare tax on earned income. As we'll look at a little bit later on about these Social Security taxes. It said about self-employment taxes, that's what they're referring to as Social Security. Social Security, you pay half and your employer pays half. If you're self-employed, you pay both halves. Now, they give you a little bit of relief on this page 1 of the 1040 by giving you an offset, a reduction for that half, but you still have to pay both sides of it. They give you a Band-Aid for somebody that's hemorrhaging bad, in my opinion. Tax credits. There's a number of tax credits, and there's new ones coming out all the time, and some old ones are expiring or are modified. And tax credits are great because deductions reduce your taxable income. Deductions from gross income, adjusted gross income, reduce the amount of tax that is going to be your taxable income. Tax credits go against your tax liability. So they're far more valuable to have tax credits than deductions. Again, deductions reduce your taxable income. Tax credits reduce the tax payment or tax liability. Okay, and they can be used in lieu of writing a check. And some credits are refundable. Some will be eliminated once you get your tax liability down to zero. You can't reduce it below zero. Refundable ones you can. Okay. Tax prepayments. Two ways this can be held. We can go. The IRS goes about it. Usually for employees, there's an amount withheld from their paycheck. And if you're self-employed or if you're an employee working for W-2 wages and you have other sources of income, you might have to pay estimated payments every quarter. I don't have mine here. I just went out in January for the fourth quarter of 2022. You can have your employer withhold a little bit extra amount. The tax there's calculations based on your filing status and your income, how much should be withheld to approximate how much you're going to owe on April 15th of the subsequent year when you file your tax. If you have other sources of income that aren't withheld, you are required to make estimated payments quarterly. It's on Form 1040 ES. The computer prints them out automatically for you if you're subject to based on the tax year you're doing for the subsequent tax year, and you can always round those amounts up, and you can refigure them, recalculate them if things change during the year. If you have a windfall or if all of a sudden your business dries up because of, say, a pandemic, they're adjustable. But the quarters are April 15th. You got to make an estimated payment. June 15th, September 15th, and then the fourth one is due January 15th of the subsequent year. I always thought that's kind of funny how they have, from April to June is a 2-month period, and then the last one is a 4-month period. Why don't they do it equally? I always had a problem that they make it due on April 15th when you may be having to write a big check to the IRS for the prior year's tax. Then you have to do an estimated payment for the current year. There's also, for estimated payments, two ways you have, what they call two safe harbor outs. You have to have your quarterly payments and your withholding and your credits have to be equal to 100% of the tax paid the previous year or 90% of the tax that is going to be owed for the current year. If you fall behind or below either one of those amounts, you may very well be subject to interest and penalties for underpayment of taxes. And the computer software that I use will compute that automatically too if that situation arises. Okay. Turn the page here. Hold on. Come on. Dependence of a taxpayer. There's two ways to go about this thing. There are people that are, the rules are very similar, but there's two scenarios we got to watch for when it's a relative and a non-relative. Okay. Dependency requirements. To qualify as a dependent of another individual, you must be a citizen of the United States or a resident of the United States, Canada, or Mexico. 2, you must not file a joint return with their spouse unless there is no tax liability on the joint return. So a dependent more or less can't be married, or if they are married, have no taxable income, no tax due. Must be considered either a qualifying child or a qualifying relative. I misspoke before. I said you'd be a relative or not. That's a child or a qualifying relative to be a dependent. Okay. Now, what's a qualifying child? Now, as I list there, there's a test. To be considered a qualifying child of a taxpayer, an individual must satisfy the following 4 tests: relationship, age, residence, and support. Okay, relationship test. Must be a lineal descendant. Could be an adopted child, a stepchild, or an eligible foster child. Okay. Relationship. Sibling or descendant of a sibling. For this purpose, a sibling includes the taxpayer's half-brother, half-sister, stepbrother, or stepsister. Under this definition, the taxpayer's grandchild would qualify as an eligible relative, as would the taxpayer's sister or grandchild. The age test. The person being claimed as a dependent, or the dependent, must be either under the age of 19 at the end of the tax year, or under age 24 if they are a full-time student. A full-time student means 5 months of the year you're in school full-time. Full-time for college is 12 credits. An individual of any age who is permanently and totally disabled is deemed to have met the age test. Okay, that's an important qualification there. Residence test. Qualifying child must have the same principal residence as the taxpayer for more than half the year. The time that the child or taxpayer is temporarily away from the taxpayer's home because the child or the taxpayer is ill, pursuing an education, or has other special circumstances is counted as though the child were living in the taxpayer's home. So if you go away to school, whether it's a boarding school, special trade school, or college, that time is deemed to be still living in the taxpayer's home. Or if you were in an accident, you're in the hospital for well, it says half the year. So if you're in the hospital for 7 months, that's because of health care. You're deemed to be in the taxpayer's main residence. You meet the test. The support test. A qualifying child must not have provided more than half their own support. So the person claiming the person as a dependent has to provide more than half of the support for the dependent. Now, the things that go into support are listed there on page 412. Now, I've got two references. I've got the chapter 4-13 and also page 59. So, food, school lunches, toilet articles, haircuts, clothing, recreation, medical and dental care, child support, allowances, wedding costs, lodging, education. Okay. But it's basically food, shelter, and clothing. You do that. It gets a little hairy when you have a divorced couple trying to, and they have a child, and who is supporting the child, and they live with both parents for 6 months here, 6 months with the other spouse, and who pays the bills, who provides for more than half the support. Again, a lot of this there is covered in the example 4.6 right there. It'll give you practical, real life situations. It'll help those things become a lot clearer. Tie-breaking rules. Again, this is when a qualifying child could be more than a qualifying child to more than one person, more than one taxpayer. So how do you break the tie? 3 rules there. If the taxpayer is a qualifying child of a parent and a non-parent, the parent is entitled to claim the person as a dependent. If the child is a qualifying child to more than one parent, the parent with whom the child has resided for the longest period of time during the year has priority. Okay. And again, a lot of this could be 6 months with both parents. Situation may, if they're divorced, may arise in a year when the child's with both parents for more than half the year, but the parents separate or divorce in the latter part of the year. Note, however, the child of divorced parents, the non-custodial parent can claim that child as a dependent if the support custodial parent signs a form indicating that he or she will not claim the child. Okay, so again, taxes. You'll find this with taxes. Taxes aren't hard, and sometimes the exceptions to the rules of taxes aren't hard. It's when you get to the exceptions. When I say the exceptions to the exceptions, that's when it gets a little complicated to keep everything straight. And just slow down, take a deep breath, and read it a second or third time. Maybe put it down on a piece of paper, or make yourself a little flow chart. If yes and no, then you go forward, and no. If you hit a no, then they can't take as a dependent, can't claim it. Finally, if the child is a qualifying child of more than one non-parent, the child is the qualifying child of the non-parent with the highest adjusted gross income. It's kind of arbitrary, but that's the rule. Again, they give you an example there, and they give you taxes in the real world. That's kind of neat. Qualifying relative. Okay, so to be a dependent, you have to be a qualifying child or a qualifying relative. Relationship test. Again, you have the relationship test, the support test, and the gross income test. So there's only 3 tests. With the qualifying child, there were 4 tests, support tests. Let's go back up. What's one you have that you don't have down here for qualifying relative? Come on, zoom up here. Relationship, age, residence, and support. So I think the age disappears for the qualifying relative. Yes, you just have the relationship, support, and gross income test. So the age is not a factor for qualifying relative, because you'll see you can claim parents and grandparents and siblings. Relationship test. Has to be a descendant or ancestor of the taxpayer. Could be a sibling of the taxpayer, a son or daughter, a sibling of the taxpayer's mother or father, aunt or uncle, and an in-law, mother-in-law, father-in-law, sister-in-law. Okay? So, a person meets the qualifying relative member of a household test if the person has the same principal residence of abode, same place of abode as the taxpayer for the entire year. This is true even if the person does not have a qualifying family relationship with the taxpayer. You have to be with them the whole year, unless it's a parent. That's the exception. Support test requires that the taxpayer claiming the person pays more than half of the support for that person. Okay. And again, there could be multiple support agreements, could be 3 or 4 kids supporting a parent or grandparent, whoever does the most support. And here's the exceptions. No taxpayer paid over half. The taxpayer and at least one other person provided more than half. And the taxpayer and the other ones would have been allowed to claim. The taxpayer contributed over 10% of the individual support for the year. Each other person who provided over 10% has to sign a statement that they're not going to take them as a dependent. Okay. And that's a form. There's a form for that, multiple support declaration. And it can get hairy. And the thing is, a lot of times in families, it could be, there could be trouble getting people to sign that multiple support declaration, because they're upset because, you took mama or grandma or wherever, you make them live in Arizona where you live or close by, and all kind of family squabbles can get into it, where you're going to need a good counselor to get somebody, or some people will just sign it and be done with it. Gross income test. The qualifying relative's gross income for the year has to be less than $4,300. That's for 2021. Again, don't memorize that number because it goes up each and every year for inflation. And just be aware that there is a gross income test, and it's rather low amount of income. Okay, now there's certain things that don't qualify for gross income. As we see there in the example, a full-time students earn $3,000 from a summer job, and they can claim her because their income was under the $4,300. Now, again, there's a income and a support test. Don't confuse the two. I give you some more examples there, quite a number of them. And there's a summary of dependency requirements in Exhibit 4.8. Does a pretty nice job there. And let's see if we're getting close. They say in Appendix A at the end of the chapter is a flow chart for determining whether an individual qualifies as a dependent or not. Filing status. Okay, this is important. You have to know the filing status to compute the tax. Okay, so one person with $100,000 of income, a single person, is going to have a different tax bill than a married filing joint with $100,000 of taxable income versus the other head of household or qualifying widow or widower. All right. Filing status, very important, because that's determines which tax rate schedule we have to use if they're over that $100,000 limit of tax. There's five, let's see, it determines the applicable tax rate schedule. The taxpayer's standard deduction amount is dependent on their filing status, and the AGI threshold for reduction of tax benefits, including certain tax credits, among other benefits. Okay, so three very important things are dependent upon filing status. They list the five filing statuses right there on whatever page this is. I don't have a reference right here handy. Well, it's either page 60, which could be also page 4-18 or 4-19. I get a page reference. I don't know if it's the top or bottom of the page. It's the trouble with these books, e-books. Five filing statuses. Married filing joint, which is usually the best for a couple, although sometimes it's better for them to. There are a few situations where they would be better with the second one, married filing separate returns. 3, qualifying widow or widower. They give you a break if your spouse dies the year of death and the subsequent year, as long as you don't remarry. 4, filing status single. And finally, head of household. So key facts there, I would pay some attention. I'd read those 2 or 3 times, not back to back to back, but every time you pick up the book, go over to those. Or again, they'll be in the highlights, this outline I send you out. And then they talk about each one of those filing statuses over the next several pages under the blue outlines. Head of household. Is filing status less favorable than married filing joint and qualifying widower. However, it's more favorable than married filing separately or filing single. Okay, you don't have to be unmarried. Now, for IRS purposes, marital status is determined as of the last day of the year. Not be a qualifying widow or widower. Okay. Pay more than half the cost of keeping up a home for the year. Have a qualifying person live in the taxpayer's home for more than half the year, again, except for temporary absences such as military service, illness, or schooling. And however, if the qualifying person is a taxpayer's dependent, then they're not required to live in the same house. They can have their own house. Qualifying person may not qualify for more than one person for head of household. Oops. Exhibit 4.9, who's a qualifying person, and it does a nice job summarizing those things. And again, another example with a number of situations there. And taxes in the real world. Is he head of household or is he? That's kind of a neat thing. Yeah. Married individuals treated as unmarried, abandoned spouse. This came in, I think, under the second Bush president, Bush 43. It used to be that if somebody was married and one of the spouses took off, stuck the other spouse with big IRS debt, especially if the guy, let's say husband and wife, traditional marriage, guy hits it big at the racetrack or something, takes off with the girlfriend, or he has a big business and just takes off for wherever, parts unknown, and takes all the assets, wipes the company clean, and they could stick the spouse who's hanging around with the tax bill. So in this case, they say it's not fair to that person left holding the bag. So they give them a bit of a break. Married, treated as unmarried, that you can go separate if somebody takes off and abandons you. Okay. Provide tax relief in these situations. Tax law treats a married person as though he or she were unmarried at the end of the year if the taxpayer meets the following requirements. There's 4 bullet points there on page 423 or 424. The taxpayer is married at the end of the year or is not legally separated from the other spouse. The taxpayer does not file a joint return with the other spouse. The taxpayer may more than half the cost of maintaining his or her home for the entire year, and this home is the principal residence for a child for more than half the year. And again, it's extended, just not your natural child. It would be adopted child, stepchild, or foster child. And again, principal residence for half the year. Again, if they're away at school or in the hospital or on military service, they're still counted as being in that home. The taxpayers lived apart from the other spouse for the last 6 months of the year. The other spouse did not live at all in the taxpayer's home during the last 6 months. Temporary absences due to illness, education, business, vacation, military service count as though the spouse still lived in the taxpayer's home. Okay. They meet those requirements. They also meet the head of household filing status and may file as head of household. It provides relief to the spouse who has been abandoned or separated and left to care for a dependent child. Otherwise, that person would have to file as single or married filing joint, and it wouldn't be fair. So there is a lot of fairness in the code. I got to chuckle at that. Everybody says, what's a fair tax? That's all. The ones that I pay less and other people pay more. Okay, there's a summary of the tax code formula at the end of the chapter here. And again, they repeat the 1040 form there, page 1 of it anyway. Page 425. Oh, come on. They got page 2, and then they have schedule 1. Is that there? Yeah. Yes, schedule 1. Okay, that's the end of chapter 4. A lot of very important stuff. Filing status and how we compute either the tax schedules that the IRS publishes, or the tax rate schedules or the tax tables. Tax tables are what the IRS publishes, but they're limited to $100,000, and anybody above that, you have to go to the tax rate schedules that appear in the back of the book. You can go to appendix. Let's see if I can find it here quick. I got it. Close chapter 4. Appendix C, tax rates, tax forms, tax glossary. Oh, come on. I want this open up. There we go. Schedule C, tax rates. There's a Schedule X, that's for single taxpayers. Scroll down a little bit. So you can see that it's a 3-column schedule, and the first column is taxable income. If it's if it starts at 0 and if it goes up to $9,950, it's taxed at 10% of the tax rate of 10%. So it'll be $995. The second row starts at $9,950 up to $40,525. Then the taxes, what it was from the first row, the $995 plus 12% of the amount over $9,950. So these are, there's a row for each tax rate: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And those are the brackets that those rates are applicable to. So the 22% bracket, the first up from the first taxable dollar, the first dollar of taxable income up to $9,950, you're in the 10% bracket. from $9,950 up to $40,235 in the 12% bracket. But again, that 12% is only the amount over the $9,950, which is the threshold, the ceiling for the 10% bracket. Then that $40,525 becomes the floor for the 22% bracket, and that goes up to $86,375. That comes down to the next bracket for 24% bracket. And it goes from $86,375 to $164,925, and that comes down for the next bracket, so on and so forth. And you can see the third thing tells you, hey, the tax is this amount plus the percentage of the amount over that threshold. Schedule Z is head of household. Schedule Y1 is married filing jointly or qualifying widower. Schedule Y2 is married filing separate. So you can see the rates are the same, but the incomes are different. So those are the four tables, and because two filing statuses are covered under the same table. Married filing joint and qualifying widower are the same table, Schedule Y1. Okay. Then they have estates and trust. Very short table there, 4 rows. Then they have tax rates for net capital gains and qualified dividends. So if a person has qualified dividends or net capital gains, depending on their filing status and their taxable income level, the rate can be 0%, 15%, or 20%. So there's only 3 rates for qualifying dividends and capital gains, as opposed to the 7 brackets. The highest rate is 37%. That's ordinary income. If you got capital gains, you're only going to pay 20%. So there's 17% savings there. Okay. All right. So, it's a little ditty on the chapter, there's Appendix C at the end of the book. And we could be using that in some of the end of chapter assignments. All right, that'll be it for chapter 4.